Does everybody know what QM stands for? Can you explain what that is?
Yeah.
I mean, maybe just, we kind of went over
a
that.
mortgage guy. He crossed over to the other side.
To the dark side.
To the dark side.
So maybe just give us the definition of qualified mortgage. I mean, it is something that came out of sort of the meltdown, the Dodd-Frank fix, right? What is a qualified mortgage so that we understand?
Okay. No. Well, qualified mortgage was put in place with certain standard that was set by the government, federal government. And those are the type of loans that are less risky, basically. Most of your conforming loans, the debt to income ratio at 43%, not interest only, not over 30 years amortization. So if the clients cannot, basically reduces the risk of getting sued by the clients, no balloon payment. So basically, certain standards were set by the federal government that no risky business, no risky loans, and those are qualified mortgage loans. So your jumbo loan doesn't fall under that, and any of those products that I just mentioned doesn't fall under that. So that's basically what it is.
So when you're speaking about non-QM, right, that's a different world.
Yes. So what happened with Dodd-Frank and all the regulation and compliance is it created an opportunity in the market for lenders to realize that, look, there are a lot of creditworthy borrowers out there that don't fit the box of QM for different reasons. They have great credit, they have a lot of equity maybe that they're putting into a purchase, or maybe they have in their homes, and they have a lot of assets, with the asset-based loans that we're talking about, but first they weren't able to secure this type of financing. So lenders started coming to the market with these type of products. One is we call portfolio lenders that don't sell the loans in the secondary market necessarily. So these lenders introduce these products, and they're, once again, they're sound loans. They just serve a certain niche in the market. And it's just, to me, I look at it, so an FHA buyer can get, with a 580 credit score, 3.5% down, buy a home, yet someone with all this equity on the hill, let's say, and they want to work with that equity to purchase a new home or what have you, or they have a lot of assets, they have great credit, they've always shown they're responsible borrowers. It's just, I started looking at it and I said, there's got to be a way to help these people. And that's why I got into the segment that I did back in 2013. And it's grown exponentially over the years now. I mean, life insurance companies have now started to get into the secondary market on these loans. New York Life, for example, invested $29.5 billion in 6 months in 2018 alone into the secondary market for these loans. And they're actually one of the smaller ones. You got much bigger Aon, AIG, that they're getting into it as well. And so you're going to see, as you were alluding to, loosening of guidelines. You're going to see just more lenders with more appetite to do these loans, and I think it's great. Like, for example, asset-based. Just to piggyback off of what you said, the asset-based loans. So now you have 10 different lenders that can offer that. Competition is good for everybody. So now they start to get more aggressive with their formulas. Mm-hmm. Now you can get all the income from assets, for example, like Sheila was alluding to, but also on top of that, you can get better rates as well, because they're competing against one another. So you can get an asset-based loan with rates in the low fours easily through a portfolio lender.
So is there a response from those insurance companies or the lender community that has an appetite for this stuff? Maybe they're not traditional lender, they're big money organizations that want to fill their portfolio. Are they looking at existing guidelines and then kind of getting outside the lines to be attractive? Are they simply competing in the same kind of guidelines but opening up more dollars? I'd like to see, and I hope that you can tell us, that they're looking at the unusual, the more creative, they're open to an application that may be way outside the box.
And I think it's both. I think it's seeing the opportunity that Fannie and agency loans are unable to fulfill, and they see, the average credit score for a home buyer in the U.S. is 674. 674.
Average credit score?
Credit score, 674 for average. They're 34 years old.
In California?
No, in the U.S.
In the U.S.
So there's the average credit score for agency loans is 700. So there is a big market out there to be filled, once again, and they see that. So they design these products to fulfill those niches, and these loans are sound underwriting. They have good interest rates. I mean, they have equity in them. So like the foreclosure default rates are very low on these loans. So, but it's also a bit of both, what you're saying. I mean, it's like, for example, lenders have just gotten more and more flexible with the amount of money that's poured into the space.
Yeah.
So I have one of my non-QM lenders. There are 40% of the loans is done on an exception basis, meaning even outside their own guidelines, which are something different, they're doing exceptions on top of that because they see that it does make sense. Because at the end of the day, it all comes down to common sense underwriting. And what's common sense? Well, 5 years ago, it wasn't as common.
Yeah.
But now, it's more common. So if everybody is doing it, or if more lenders are doing it, then they feel more comfortable with it. And,
Can you give us a quick example of something just unusual or interesting, or that you've recently or in the last couple of years put together? Yeah, that no one else on the planet could put together except for you.
So I had a buyer who was buying her forever home as a new build, $2 million purchase, and great business, 13 years in existence. She generates $60,000 a month in revenue. Yet, because of a situation with her family, her daughter, she didn't have a lot of money to put down on that purchase. And on top of that, she's a small business owner. She's self-employed. And like a lot of people out there, self-employed people take deductions on the taxes, and understandably so, especially where we are in the state of California. So she couldn't qualify for a traditional loan with her tax returns. So I set up what's called a bank statement loan, which is all in the packets that you guys will see in my folders. It's basically looking at the deposits that are going to a business bank account for the past 12 months. Actually, it was 24 months. So
Deposit, so like a cash flow kind of
cash
thing.
flow, exactly.
Got it.
And no one was willing to do that loan. This was a year ago, February. And no one was willing to do that loan because of the size of the loan. It was a $1.9 million loan with 10% down for a bank statement financing with no tax returns. And similar to what I just said, I found an investor who was willing to make an exception to go above their max LTV of 85. We got to 90, we closed the loan. I mean, she's got a high credit score. This is a forever legacy home that she's going to pass on to her daughter. She will never default on that loan.
No, right.
And the fact of the matter is, I mean, it's interesting because lenders back then, a year ago, I had only one lender. I had to get an exception to this loan. Now, I have a similar situation, similar scenario. 12 lenders that I had that were willing to offer.